Welcome to vTalkInsight, Market Drivers Daily for April 23, 2026. Triple-digit oil, persistent Gulf tensions, and a historic wave of AI spending are pulling risk assets in different directions today. We will connect the energy shock, the AI Capex boom, and a powerful earnings season to highlight where resilience is real and where it may be fragile. Energy and geopolitics remain at the core of the macro story, with the Strait of Hormuz still effectively choked off and crude trading firmly above $100. Commercial shipping through the Gulf has largely halted, with blockades, mine threats, and vessel seizures forcing tankers and LNG carriers to stand aside. Brent has now spent several days above $100, and spikes toward last month's $120 highs are back on the radar if tensions escalate again. The immediate impact is a higher geopolitical risk premium in energy, but the deeper issue for markets is that this looks less like a brief shock and more like a drawn-out regime shift in supply security. The physical stress is most visible in gas and LNG. All LNG tanker traffic through Hormuz has been halted since late February, removing around 20% of global LNG supply from the market. Each additional week of closure is equivalent to losing enough gas to power a major city, and 7 weeks of disruption have already stripped roughly 10 million barrels of oil from global supply. Insurance costs for shipping have doubled, up to 10% of tanker capacity is effectively trapped, and a wide, persistent gap has opened between Brent futures and physical crude prices, signaling dysfunction in price discovery and tight, prompt availability. Emergency inventories are being drawn down quickly, and there are growing doubts that official stockpile figures accurately reflect what is really available if disruptions drag on into the summer. The macro spillovers are uneven across regions. Emerging markets, such as Indonesia, are feeling the strain of oil above $103. With weaker currencies and equity markets as fuel import bills surge. Europe looks particularly exposed. The recent oil and gas spike linked to the Iran conflict has reportedly cost the European Union tens of billions of euros already, pressuring inflation and contributing to downward revisions in German growth forecasts. European equities are underperforming, with most indices in the red and only energy and a handful of defensive sectors providing support, underscoring how the region is disadvantaged in both peace and conflict scenarios given its energy dependence and limited exposure to AI leaders. In contrast, U.S. assets benefit from America's energy position and ongoing demand for U.S. exports, and dollar funding pressures are prompting multiple Gulf and Asian countries to seek swap lines to stabilize their systems. On the corporate side, airlines are on the front line of this shock. Higher crude has pushed jet fuel sharply higher, adding an estimated $4 billion in extra costs for some major U.S. carriers this year and forcing European airlines to cut flights and prioritize transatlantic routes. Multiple U.S. airlines are trimming profit forecasts or declining to reaffirm guidance, while weaker names seek government support, and consolidation discussions and revenue-sharing partnerships are accelerating as carriers search for scale. Higher gasoline prices risk becoming a political issue in the U.S. if they persist into the election season, while in developing economies, elevated fuel, fertilizer, and food costs deepen poverty and raise the risk of social unrest. If the shock endures beyond a quarter, the adjustment is likely to shift from inventory drawdowns toward demand destruction and lower economic activity, raising the specter of a stagflationary backdrop. Despite this, risk assets are not trading as if a full-blown crisis is guaranteed. U.S. equities remain near all-time highs. Stable long-term Treasury yields help justify elevated equity multiples, and crude has shown bouts of intraday weakness even with Brent above 100. Some argue that structurally high prices will ultimately curb demand, that China's large strategic reserves offer a buffer, and that oil companies' reluctance to increase capital expenditure reflects skepticism that triple-digit prices are sustainable. However, yesterday we noted markets leaning toward a relatively quick Gulf resolution, and today's evidence of entrenched shipping disruption, Iran's mounting storage constraints, and leadership churn in U.S. defense circles keeps the tail risks very much alive. Key watch points now are ceasefire and negotiation headlines, real-time tanker and LNG flows, any announcement of expanded dollar swap lines, and the reaction of energy-sensitive earnings. Against that volatile backdrop, one structural growth engine continues to dominate the upside narrative: the global AI investment cycle. The AI theme is no longer just a tech story. It is increasingly the backbone of the growth narrative. AI-related capital spending is estimated to contribute roughly 35 to 45% of recent economic growth, with this year's data center leasing and semiconductor investment alone running around $300 billion. Looking ahead, projected AI Capex by hyperscalers of roughly $750 billion signals a long-duration build-out in compute, networking, and power infrastructure. This has underpinned one of the strongest semiconductor rallies in decades and is helping to offset some of the macro drag from higher energy prices and headline growth figures. Enterprise adoption is moving quickly but unevenly. Some large investors report that about 90% of their portfolio companies are pursuing AI initiatives, and OpenAI expects corporate clients to account for half of its business by year-end, with platforms like Codex already reaching millions of weekly active users. ServiceNow has lifted its 2026 target for net new AI annual contract value from $1 billion to $1.5 billion, and argues that large enterprise software platforms will integrate language models rather than be displaced by them. At the same time, research suggests only around 20% of companies are currently seeing meaningful earnings benefits from AI, and that success is more likely when management focuses on a small number of high-impact use cases instead of scattering resources across many experiments. Crucially, effective AI transformation appears to require up to $3 of spending on people and processes for every dollar on technology, with roughly 3/4 of jobs expected to be reshaped at the task level rather than simply eliminated. This wave of AI adoption is reshaping capital markets and industry structure. Blackstone reports a 15-fold increase in large language model spending across its portfolio and expects 2026 to be its strongest IPO year ever, with deal pipelines heavily skewed toward AI beneficiaries and related infrastructure. Private equity portfolio revenues are growing at around 10%, helped by data center, LNG, and battery storage investments tied to compute demand, while venture investors highlight rising consolidation pressure on AI startups as compute and data center access become too costly to fund independently. SpaceX's option to acquire AI startup Cursor at a valuation in the tens of billions, alongside Tesla's decision to triple AI and robotics capital expenditure to around $25 billion, illustrates how both traditional tech and non-traditional players are racing to secure talent, chips, and platforms, even as markets question the near-term earnings impact of such aggressive spending. On the credit side, a projected $750 billion of AI-related Capex is expected to drive increased investment-grade tech bond issuance, creating a potential technical overhang and wider spreads in parts of the debt market. Alongside the upside, the risk landscape around AI is getting more complex. Software valuations have already re-rated lower in many cases as investors grapple with uncertainty over disruption, with companies like ServiceNow and Zscaler seeing sharp share price moves when guidance misses or competition from new AI tools is perceived as a threat. Global demand for open-source AI models is rising, especially among sovereigns that want control over infrastructure, but that raises contentious safety questions as more powerful models become widely accessible and increase cyber risk. Financial firms are in an arms race for high-performance computing, with players such as Citadel using AI to update complex risk models far more frequently, while enterprises respond to AI-driven vulnerabilities by ramping up multi-vendor cybersecurity spending. There is also an unresolved macro debate. AI-driven efficiencies could eventually help central banks justify rate cuts, but the technology's heavy demands for electricity, water, and data center build-out may add to cost and inflation pressures in the near term. For markets, the key is dispersion. With AI wealth creation highly concentrated in a narrow slice of equities and households, investors are increasingly differentiating between firms that can convert large Capex and focused use cases into higher margins, and those that are simply adding risk and leverage to already stretched business models. That dispersion is on full display in this earnings season. One reason risk assets have remained resilient despite energy and geopolitical shocks is that the earnings backdrop is unusually strong. Across major indices, roughly 88% of reporting companies are beating expectations, delivering more than 10% earnings growth. And recent commentary points to robust U.S. corporate profits supported by nominal GDP expansion, ongoing inflation, and late-cycle fiscal stimulus. Nowhere is this clearer than in semiconductors. SK Hynix has reported a five-fold increase in quarterly profit on the back of surging memory prices and data center demand. STMicroelectronics and Texas Instruments have both beaten estimates with upbeat guidance tied to AI and cloud infrastructure. And Intel has delivered a sharp turnaround with revenue, margins, and its data center business all rebounding strongly. These results help explain why semiconductor indices have logged record winning streaks and gains of around 30% or more this month, anchoring the broader tech-led rally, even as macro risks accumulate. Beyond chips, earnings are highlighting clear winners and laggards across sectors. On the consumer side, brands like Nestle and L'Oreal are posting robust sales growth in snacks, coffee, hair, and skincare, demonstrating pricing power and resilient demand despite higher input and logistics costs linked to energy. Payment and travel-related names, such as American Express and several U.S. airlines, are seeing strong premium spending and record revenues, with luxury retail, premium travel, and affluent cardholder activity all growing at double-digit rates, even as rising marketing costs and fuel bills weigh on profitability and share performance. Industrial and infrastructure names tied to electrification and AI, including Vernova and Trane, are reporting powerful revenue growth linked to grid upgrades and data center cooling demand, while European defense companies like Saab benefit from sustained order backlogs and higher spending in the Nordics, Baltics, Germany, and Poland. In contrast, energy-intensive sectors such as airlines are cutting guidance as fuel costs surge. Some carriers seek bailouts, and European equity indices trade lower with only energy and a few defensives in positive territory. The key question is how long earnings can offset the macro headwinds from oil and geopolitics. Major U.S. indices are back near all-time highs at roughly 21 to 22 times forward earnings, with gains heavily concentrated in AI and tech leaders and ownership skewed toward the wealthiest households. Recent S&P 500 performance shows some cooling, with several down days after a strong run, and futures are softer as markets digest both stellar chip results and more mixed outcomes in software and energy-sensitive industries. If oil remains above $100, there's a risk that margins for cyclicals and travel names come under renewed pressure, potentially triggering a rotation toward more defensive sectors, while a renewed escalation in the Gulf could quickly spark a flight to quality and a spike in volatility. Looking ahead, the focus will be on forward guidance from airlines, consumer, and industrial companies on energy costs, on whether semiconductor firms can sustain current order backlogs amid capacity constraints, and on how central banks balance strong earnings against energy-driven inflation. Pulling the threads together, markets are currently leaning on robust AI-linked growth and powerful earnings to absorb an ongoing energy shock, but that equilibrium depends on both geopolitical containment and continued delivery from the corporate sector. To sum up, triple-digit oil and persistent disruptions around the Strait of Hormuz are embedding a higher geopolitical and inflation risk premium into energy, with airlines, Europe, and parts of emerging markets most exposed, even as U.S. assets benefit from energy and dollar strength. At the same time, an exceptionally powerful AI Capex cycle is driving semiconductor outperformance, supporting earnings upgrades and fueling IPO and credit pipelines, but monetization remains concentrated and capital-intensive, raising questions about sustainability and dispersion between winners and laggards. Finally, a very strong earnings season, led by chips, premium consumer brands, infrastructure, and defense, is helping equities look through near-term shocks, although high valuations, narrow leadership, and energy-sensitive downgrades keep the risk of a sentiment reversal on the table. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.